Thank you for joining us today. My name is Lindsay Redden. I am a wealth planner for Thrive Wealth Management. I focus on retirement succession and estate planning in the agriculture sector. Farm succession planning can feel overwhelming, so I'm happy to be able to bring an expert to share his knowledge with all of you today. A few housekeeping items before we get started. I just want to let everyone know that this session is being recorded. If you'd like a copy of the session, please reach out and we would be happy to provide that to you. Also, if you have any questions during today's webinar, we will have a Q&A at the end. And finally, if everyone can just make sure your microphone is muted during the presentation, that would be great. I am very excited to have Doug Carroll here to discuss farm succession planning. Doug is the tax and estate specialist for Aviso Wealth, a wealth management partner to credit unions across Canada. He previously ran an estate planning law practice and was an advanced case consultant with a life insurer and a mutual fund provider. Doug holds a business degree and a Master of Law specializing in tax and is qualified as a certified financial planner and a trust and estate practitioner. With over 25 years experience and expertise, we are fortunate enough to have him here to present for us today. So without further delay, I would like to welcome Doug Carroll.
Okay, thanks, Lindsay. And we've got the slide up here, the welcome slide for everybody up here on the screen. And I'm going to take you through this topic about farm succession planning. As Lindsay mentioned, my background is along the legal and tax, and particularly in terms of legal estate planning type of expertise. My involvement in the farming sector has been from time to time over the last 25 years with client discussions that I've had. But to be fair on it, I am not an expert in farming. Farming itself, obviously, is not what I'm talking about anyway. But operationally, the tax issues associated with operating a farm, specifically what we're talking about here is succession and the legal and the tax rules that are in place to assist with that. And when I'm involved in discussions, I work with Lindsay, I work with other advisors who have much more of a farming contact and knowledge of farming operations, along with yourselves as the people who are running those farms. And together we contribute in our parts of the conversation to look at the ways that the farming succession can be set up in an effective way. So I'm going to take you through a few topics here, 10 topics that I've got up here on the screen. The first few are just positioning the reasoning for the special rules that exist for farming succession, and then getting into planning on a non-technical basis, just the structure of planning and breaking it down for yourself in being prepared for when it is you're going to do the succession and how it is you're going to be doing the succession, and then move on to talk directly about some of the tax rules, some touching on the operational part of using a corporation in running any kind of a business, but particularly a farming business. And then after that, the second half or so of the points that you see here are points having to do with special tax rules that assist with farming succession. I may, just because I tend to talk on this in different places, I may say sometimes farming and fishing, because most of the rules that apply for farming succession also apply for fishing, for fisheries. And so if I do that, obviously I don't misunderstand who I'm speaking to, but just to understand that the special rules are distinguished for all other types of business activity and then farming and fishing. So I'm going to take you through the topics that we have here, with the focus obviously on farming, and this particularly the farming succession, based on what farming is and the long-term capital-intensive nature of it, is much more towards farming than it is towards fisheries. But it is true in terms of the commitment that people make, that you have in any kind of a small business, quite often a lot of your own capital devoted towards running the business activity. Where we have farming, it is very capital intensive and land intensive in many operations. And if there were not rules that assisted with the succession of a business down generations, so remaining within the family structure, then it would be very difficult for families to continue that on, to pass on the knowledge, to pass on the expertise, and keep that operation in the family, whether it's a small or large operation. Without these rules, it would be very difficult for that to happen. So not only do you have, in terms of operating your business, a long-term view of what you are doing year to year and out for quite a number of years, but you have that long-term view and commitment towards the business activity, the farming activity, and similarly, in order to do an effective succession of the farming operation, you need to have a very long-term view of how that's going to happen. With a lot of businesses, the business may be asset rich and cash poor. So you may very well, if a non-farmer drives by your place, may look at the buildings that you have and the machinery that you have, and see all of that, and look at how substantial it is, and be really impressed by that. And that's true that that you need to have invested a lot in that, but you need to run that in an effective way. And so quite often you have that large amount of land and plant and equipment that is needed in order to generate cash. And in a relative sense, then it's somewhat cash poor in a lot of cases compared to the amount of assets that are put into running the business activity. The extra part of that for a farming operation is not only is it that you have machinery and land committed to it, but the land itself is a place where you live. And so the classic type of comparison or analogy of goose and golden egg, that business owners will invest their wealth that they earn back into the thing which generates the income that they earn. The added part for farming is you live on the land where it is that you have a lot of your wealth devoted towards generating the income that you take out of that land. So there's all sorts of reasons why you need to have special rules to assist with the transfer of these business activities and these assets, without which there would be significant taxes that would apply on the transfers, and would make it very challenging to transfer the business operation onto family members, or even if not to transfer onto family members, to transfer over to others and be able to step away from it with a substantial amount of the return of having devoted so much capital towards running this particular type of business activity. So with that, I want to turn to the planning activities. Again, looking at this from a non-technical standpoint, but breaking it down in a way that that you can look at your planning, and depending on what your age is, what stage you're at in terms of running your operation and leading towards your later years, you may very well be well along the track, or this may be something that you're looking out much further into the future. And so breaking it down, it's helpful to distinguish the type of planning that is necessary. And not say that this is the only way to do it, but the suggestion here is to look at it like a three-legged planning stool, where the first part of the planning is about you, the second part is about the farm, and the third part is about those who are going to be your successors, as successors, as in owners as well as operators. So starting with you, the tax rules exist that will help out with transfer of property, but it's not going to change the fact that you're going to go into your later years, whether you call it retirement or just winding down, or just later stage, whatever name you want to put on it. What kind of a lifestyle will you have, do you want, during your later years? And this isn't to suggest, because that word lifestyle sometimes gets connected up with the lifestyles of the rich and famous. It's just a straightforward, what kind of things are you going to be doing? How are you going to be living your life? And where are you going to be living your life in those later years? Then what is it going to cost to fund you for doing that, to pay for those things? And where is the income going to come from? If it's going to come, if your expectation is it's going to come from the farming operation, that means that you're going to continue to be connected to it in some way, which then affects how it is that you set up the succession and the expectations of those who are going to follow in behind you. So what kind of income is necessary to support the lifestyle that you have, or the other side of it might be what kind of lifestyle is available because of the income that you expect to have in those later years. And that income, apart from coming from the farming operation, may very well be coming from invested money elsewhere. Again, it's quite possible that you have earned money from the farming operation and plowed it back into the farming operation. So that's the prime source that is going to be the place where you're going to get the funding for your later years. And if that's the case, then again, it's a good idea to understand these tax rules that are available to help you out so that you can actually live that life which you're entitled to. So that's about you. The second part in the planning is about the farming operation itself and how well it is ready to be transferred on to someone else, but particularly on to the next generation if it's going to go down generations. And certainly, as I'm talking about most of these rules, they are about preserving to go down generations, but you may very well be selling to someone else altogether, and a number of these tax rules will nonetheless be helpful to you and reduce down the tax bill that you might have when you are doing that. So the operation itself, is it ready? Is that a place where someone else can step into your shoes and pull the levers, turn the cranks, and produce out of it what it is that you can produce out of it? Or is there something that needs to be done to it in order to get it to that point? Do you have well-documented procedures for the things that you do, the expertise that you have? Have you documented in a way that that is referable? So is it something which is on paper or on computer or somewhere that somebody can look at? And or how much have you then transferred in terms of the expertise and the wisdom of what it is that you're doing by guiding and teaching again your children as successors to you, so that they're able to do that? And if they're not able to do that, and you've identified the successor, it could be more than one, but I'll just refer to this as a single successor. If you've identified who the successor is going to be, and the needs of the operation require more skills than that person has currently, what kind of gaps are there? How do you get that person to the point where they have the necessary skills, and how long is it going to take to get to that point? So this is your successor in terms of operating the farm, which may very well be, as we turn to the last type of planning here, it may very well be the same person who will be the outright single owner of the farm, but it may not be that that's the way you're going to go about it, because you may have other family members, other children, and you may want them to be involved or have the benefit of the farming operation. And if not have the benefit of the farming operation, you may want to set them up so that there is something that they are getting as an inheritance or a transfer from you, which you feel is appropriate in the circumstances. And the reason why I say that is that if the person who is the successor operator is the entire owner, then it makes it really simple. But as you have others that might be involved, then you need to look at how they are going to be involved. Would you really want to have your one son being the owner operator of the farm operation, and then have your other children not involved being able to receive some kind of a draw off of the income that is generated from that farm operation? And if that's the case, do you want them to be involved in the decisions about the farm, given that they are not actively working the farm like the individual is? Or do you want them to be on the outside? In that case, you may need to be more structured about how you set things up. You might have to look at doing a corporation if you don't yet have a corporation, and setting up the share structure to keep the distance between the operator and those who are the other owners, the other family members. You may look at setting up some kind of a trust. The other possibility might be, as is more often the case, that you want the one or the more, but the one one successor to be able to run the farming operation and not be fettered by those others getting involved and getting in the way. And so you'll look to what we usually say in estate matters is equalizing the estate or equalizing the transfers. But I've used the word here saying equitization because the bulk of your wealth is likely in that farming operation, whatever it might be worth, $2 million, $5, $20 million. You don't have another $2, $5, or $20 million that you can say, oh, that's what's going to go to those others. And particularly if you've got multiple others, you can't multiply out all of those other assets to duplicate what is the core of what it is you're transferring on, which is likely going to be the farm itself. So how do you go about doing that in an equitable way without necessarily being equal? And how do you prepare for that yourself? How do you prepare them for that? And the usual way that that can be the stand-in tool for that purpose, usual way that that is carried out is by choosing other assets to go to those others and to make it substantial, to look at life insurance as a way to have a stand-in. So estate planning overall is usually sufficient for the average person as an employee, doesn't own their own business, let alone a farming operation. It's usually sufficient for most people to have a will and powers of attorney. A will is the core document that says what's going to happen with your property at the point of your death. And then powers of attorney allow you to name someone who will take care of decisions about you or about the property you own while you are living, if you are incapable of making those decisions at that time. But then when you have a farm operation, you need to look at the possibility of setting up these extra tools, extra devices, as I mentioned, possibly using a trust or a corporation, freezing values. And those of you who looked into this already might be thinking, well, why would I need to be doing a freeze of values? It's a tax maneuver. Why would I need to do that? Because we've got these assistive tax rules available. You probably would not look at freezing ownership based on a need to reduce taxes, but you may very well do it as a way of maintaining control during your lifetime and while you're running the activities. And also later on when maybe you are not running things, but you are making sure that you can keep an eye, make sure that you can keep those divisions as necessary between the family members. And then when you're no longer around, setting up so that there can be a reasonable transfer without causing any or very little harm to relationships and causing acrimony. One of the things you can use is joint ownership, adding on one or more of the children to ownership of parts of the property. Life and disability insurance, as I mentioned, are certainly financial tools that are available. And then the last thing here about family law issues, generally when people are thinking about their estate planning, and this goes back in myself in running law practice, where I would see seniors quite often who are concerned about making sure that their property would transfer down to their own children, but not necessarily go to their son or daughter-in-law, and particularly not if there was a breakdown in the relationship. So not to say they don't care or love their son or daughter-in-law, but they want to make sure that things remained within their family structure. That's especially important when you're talking about farming activities because, bringing it back, not that you don't know this much better than I know it, if you're living on the land where the farming activity is happening, then there are special rules associated with the home that a couple is located in. You have the potential, based on the way that you have transferred the property, that a substantial amount of that property may very well be caught up in a breakdown of that relationship. And if those assets have to be divided, then if there hasn't been proper planning put in place to guard against it, it could be a significant impairment of the farming operation. It could lead to the sale of the farm just to manage the breakdown of the relationship. So family law issues are fairly significant for farming, particularly beyond the average person's estate planning considerations. So I mentioned I was going to talk a little bit about corporations, and I appreciate that there's a lot of numbers that are showing up here on the screen. But let me just walk you through this. We're only concerned about the Saskatchewan numbers, which is the third line down there. The rest of the numbers, just totally ignore them. If you're running a business, you can run it in three main ways. Any business, you can run it in three main ways. It can be a sole proprietorship, where it is one person who owns the business, and that person expends the capital to do that. You calculate out what your net income is. So you have your revenue minus your expenses, and you have your net income, and then that is taxed to you personally. You also have the possibility of running in a partnership, which would be two or more. There's no limit on how many it might be, but two or more people as members of the partnership, and there would be an agreement between them as to the percentage of the income that each would be entitled to, and it could be based on how much is contributed in by each, or it could be something else that's negotiated between them. But what happens under a partnership is the income that is generated from the partnership on a yearly basis. Again, there's a calculation of the net income, and the net income amount is allocated out to each of the partners and is taxed to them personally. And then with a corporation, we've got a distinct legal and taxable entity in the form of a corporation, where the corporation is its own taxpayer, and the owners of the corporation are the shareholders. So you can run a business activity inside of a corporation and not have to pay out the net income to those who own it just yet. Eventually, it needs to come out. And by doing that, you may very well be able to be more efficient in the way that you reinvest the money in the corporation. So looking at the line here under the small business rate, I'm going to leave aside the general rate over on the right hand side, because the concept is the same with each. The income that's available under the small business rate is up to $500,000 of business income that you get the small business rate on, and then above that you have the general corporate rate. I believe it may be up to 600 on Saskatchewan, but the federal rate, which is the more substantial part of that, is 500,000. So looking at that way, on your first $500,000 of income, you would pay a flat 9% tax rate, whereas personally, we pay tax at a low bracket rate as on the lower levels of income, and then we go into higher tax brackets as we go up. So I'm showing you here top tax bracket, not that everyone every year is always at top tax bracket, but generally your personal rate will be higher than the 9% that's available to the corporation. So comparatively, if you were to earn the income of running a farm, either personally or through a partnership, you would be taxed, again, was pushing it right up to top bracket, which is over about 220,000. You would be paying tax on the income above that level at 47.5%. So you would only have 53 cents, roughly 52.5 cents, to reinvest in the business activity back into the farm. Whereas if you run through a corporation, the corporation has 81 cents, because you only paid 9% on that. So you have 81 cents that can be then invested back into the operation. Of course, some of that has to come out on a yearly basis just to support you, but the excess beyond that, you can reinvest 81 cents instead of the more around 50 cent level for the corporation. So that's why it can be quite helpful, notwithstanding that there are these tax rules that I'll turn to just shortly, that help out for farmers to run farming operations for the sake of succession, that you don't have to have a corporation. On a year-to-year operational basis, it can make very good sense to run through a corporation. But as I said, you do need to take the money out into your personal hands in order to spend it. And so though the corporation is subject to a low tax rate, again, showing here the 9% rate, once the money is paid out from the corporation to you personally, then you pay tax on the dividends that you receive. And so the 9% that the corporation pays, add to that what you personally pay, and it totals up to 47.5% for Saskatchewan. In some of the provinces, there's a small difference, 1.5% difference maybe, of running through the corporation and then taking out into personal hands. But for Saskatchewan, it integrates to the point where you pay pretty much the same amount once you get that money out into your personal hands, whether you have run it as a sole proprietorship or if you run it through a corporation. So just give you some background there on the benefits of running through a corporation. So now I'm going to turn to the rules that support farmers in a positive way on the transfer of farming activities. This one is probably the most well-known of the benefits of having a farm operation, and it applies actually to small business shares as well as to corporations. So generally, or to farming and fisheries. So generally, when we sell a piece of property, we have a cost base for it, what we've invested in it, and we sell it for something above that, which is the selling price or the fair market value. So the difference between our cost base and the market value, fair market value, that's your capital gain, and half of that is non-taxable, the other half is taxed. So that's a positive benefit of capital gains generally. But then there is this lifetime capital gains exemption, which is available to small business shares and to farming and fishing activities. So this was established back in the 1980s. It was actually a general capital gains exemption, which then was changed to like general as in everybody had it available to them. And then it was changed that it was only available on small business shares and farming, and then eventually on fisheries. The value used to change every few years when the government of the day would decide to bump it up from whatever it was. It started out at 100,000, and then it got moved up to 250, 350, 400, 500. So it was moved up from time to time by the government. And then a few years ago, it was set at 750, the next jump, and then became indexed. So they didn't have to have a government intervening. It just is indexed every single year. It stands right now at around 913,000 that it protects against the taxation of the capital gain when you dispose of farming fisheries or of small business shares. That number, the 913 number, applies to the small business shares. But for farming and fisheries, about 5, 6 years ago, 7 years ago, maybe it was, in the mid-teens, the rate for farming and fisheries was pushed straight up to $1 million. So if you're running farming and fishing activities that you own personally, or you own through a partnership, then you get the $1 million of capital gains exemption. You're not limited to the current 913,000. And that, again, as I said, that indexes from year to year. If you are running a farming or fisheries activity through a corporation, because of the nature of the underlying activity, those shares of the business corporation are allowed the $1 million capital gain. So that index, that 913 amount that's indexing from year to year, it indexes just like our tax bracket rates index, uses the same factor to determine the indexation. And so once that figure then goes past $1 million, and it'll be a few years yet before it gets there, probably 4, 5, 6, 7 years. The index rate depends on the performance of the economy, and it ranges from about 1 to 2.5%, 3% sometimes. And so once that breaks past the $1 million level, then the farming and fishing capital gains exemption will just go up with that. So 1 million is what it is currently, which is above what the rate is for the shares, and they all will go up beyond $1 million once the indexation takes it to that point. When you're selling property, whether you're selling the shares of a corporation or you're selling individual assets, capital gains exemption is not the only consideration that comes into play. If you are directly selling land, then there may be land transfer tax or the equivalent term by province. That's my generic reference that I use for that. It varies by province whether there is a charge on the transfer of land and how it is charged. You also have the possibility in selling individual assets, a piece of machinery that GST, HST, again, depends on province how that's applied, whether that applies to that sale of those assets. Some of the concerns that come up is you as the retiring person who's selling that off, and I say retiring in more of a generic sense than saying that you're not going to be working at all, but you as the one who is selling because you're leaving that particular operation, when you sell those assets, you're going to have a significant capital gain. You're going to have income. You're going to have a cash flow from someone who is buying from you. And you run the possibility, based on your age, that you may end up with a clawback of your old age security. Your old age security becomes available as early as age 65, although it can be delayed, and you can take it out to age 70. And if you delay, then for every month that you delay, there's an increase in the amount that you receive from the date that you actually start. So you can take it out as much as 5 years. The limit to it is that at a certain income level, then if you exceed that income level in a year, your old age security is reduced in the coming payment cycle of the old age security, which runs the following year, roughly from July to June of the following year. So when you sell property and you have a large capital gain, there may be a reduction to your old age security. And there also may be that you will face what's called the alternative minimum tax. And I'll talk about that directly, and I hopefully I don't confuse you too much with this, because it's something which is not an everyday concern for most people, because it doesn't usually apply. It is actually a parallel tax calculation that is happening all the time for all of us, but it doesn't usually matter, because the regular tax calculation of us going up through tax brackets and getting our regular deductions and our regular tax credits on a general basis means that we will pay tax based on that calculation. However, when you have a large amount of deductions or credits that are out of the ordinary or out of proportion to what the income that you have, the alternative minimum tax may actually be larger than the general tax calculation. So what the alternative minimum tax does is it adds back some of those deductions and credits to put you in a place where if you didn't claim those, then you still will have to pay a certain amount of minimum tax. So the big thing that can happen, particularly on the sale of business activity and a farming operation, is that the non-tax half of capital gains, remember I said that capital gains, you've got your cost base, you have your sale price, your market value, and of this increase amount, half is not taxable and the other half is. Well, the non-taxed half of the capital gain is added back in for the calculation of your exposure to the alternative minimum tax. And even if you're able to use the lifetime capital gains exemption against that in the general calculation, it doesn't change the application of the alternative minimum tax. So once the tax preferences, those extra deductions and credits that you're able to claim, and I'm just talking here about the capital gains non-tax portion, but there are some other things that will get added back in again. The big one, though, being the capital gains issue. Then you take a single deduction of $40,000 out of whatever the income amount that is determined there, and the net figure is multiplied by the lowest federal tax bracket rate, which is 15%. If that calculation is higher than your calculation under the usual tax application, then you will pay tax based on the alternative minimum tax. Now, this isn't an additional tax. What's intended to happen here is you've got a larger amount under the calculated alternative minimum tax than under the regular calculation. So you're required to pay the alternative minimum tax in the current year, but you get a credit in future years to recover back the alternative minimum tax for the next 7 years as a credit against your future taxes that you need to pay. However, for a farmer who is going to cease activity and possibly cease taking very much, if any, income thereafter, If you don't have income in those subsequent years, over those next 7 years, you may very well have that alternative minimum tax that applied in the year of transfer, the year of sale, that you never are able to recover if it is very large and you have very low income. So very important conversation at an early stage of things with your accountant and your lawyer, I guess, but more so your accountant, about your intentions and your intention in terms of transfer and the potential exposure you would have to alternative minimum tax, which then may lead to a change in your expectations of how you're going to go about doing the transfer and when you're going to do that, and perhaps then making some changes on a current basis so that you can reduce that exposure later on. The another rule that can provide some relief, although it's probably unlikely, as I understand it, in any conversations that I've had with accountants, not that we're chatting every day, but whenever I've had the opportunity, I've asked about, is this used that much? The principal residence exemption is available to all of us on our principal residence. We don't pay tax on our capital gain of our principal residence. And there's a two-part rule for farming that you can use to claim the principal residence exemption. For the rest of us, so to speak, the principal residence exemption applies to the property, to the building itself, or if it's a condominium, the condominium, but to the home, the physical structure itself, and the land as much as a half hectare in size around that property. So it allows for the usability of the principal residence. If you have that principal residence on farming property, though, then there's lots and lots of land that's surrounding it, and the coordination between the principal residence exemption and the lifetime capital gains exemption could be confusing if you were able to just say, oh, well, this farmhouse, my home, is on this land, which is 600 hectares, whatever size that is, and therefore it's all protected. Well, it's not. So you have two ways that you can calculate this. It can either be the usual rule with the half hectare, or it can be an allocation of a dollar amount based on post-1971, which was back when the tax system was significantly changed in 1971 when capital gains started becoming taxable. So it's $1,000 plus $1,000 per year after 1971 that you've owned the property. Back in 1971, $1,000 for property was a pretty large dollar figure. These days, I don't think that that's going to affect much. You'll probably use the first part of the rule in the normal way and not use the second part, but it is there and it's available. If you're interested in that, again, your accountant would advise you on what's appropriate. Now, if you own your home through a partnership or a corporation, things might be a little bit different. If you own your home, your principal residence, through a partnership, generally the partnership will allow, the rules will allow you as a partner of the partnership to be able to claim the principal residence exemption on the property, but it does depend on how the partnership is drafted up. If you own your principal residence inside of a corporation, it may very well be that you've been running the business through a corporation, and because of the reinvestment, like I said, the 47.5 versus the 9%, the reinvestment of money inside the corporation meant that there was excess cash in the corporation beyond what was needed to go back into the farming operations, and it built up to the point where it gave you enough that you could buy a home with that money inside the corporation. And that may very well, and probably was, a tax efficient way to acquire the home. But if the corporation owns that home, the principal residence exemption is not available. So that's the concession that you make in doing that, is if you buy within the corporation, then you're not going to get that standard rule of principal residence exemption available to you. You would have to dividend the money out of the corporation into your personal hands to acquire personally in order to use the principal residence exemption. Then the last point here about principal residence exemption reporting. Since 2016, there's been much more detailed reporting required for the principal residence exemption. It doesn't change the fact of these rules. It just means the records need to be shown of what you acquired for, whether you made any capital improvements to it, if it was used for other purposes like rented out or used for a business as a business itself, the principal residence, which might limit the availability of the principal residence exemption. So just be aware that there's extra reporting involved. Again, you're working with an accountant, and so your accountant would be taking care of the details that would make that available to you. But if you are at the point where you are selling the principal residence, then there'll be some extra reporting required in the year that you sell that property. Now, in order to make use of these rules, and it's sometimes hard to put these rules in order of which one to talk about first. So I already talked about the lifetime capital gains exemption. The exemption applies, again, to small business shares and to farming and fisheries. Well, what constitutes farming property? So qualifying farming property is a definition that you have to fulfill in order to use the lifetime capital gains exemption. And it's also necessary for some of the rules I'm going to talk about next about transferring property down generations. So the types of things that qualify as farming property for the sake of these rules are the first line items here: land, buildings, quota, and intangibles related to the farming activities. Don't ask me to define intangibles here, but things that are related to the farming directly, those types of things that again, conversation with your lawyer can outline depending on the kind of business activity you have, whether there are any intangibles. Those are the things that are qualified farming property. Things that are not qualified on their own, if you own these directly, are equipment, machinery, and inventory. Those three items, though, if you hold those within a partnership or within a corporation, you may very well, particularly inside a corporation, you may very well get the benefit of those qualifying as qualifying farming property based on how that is set up. So again, another reason why, depending on the size of your operation, how much you have as assets, why it is a corporation may still be beneficial to hold on to run a corporation, even if some of the transfer rules don't require you to have a corporation in order to transfer on to family members on a tax deferred basis. Again, which I'm going to explain to you in just a moment how that works. In order to be qualified farming property, there is a significant point in time when the rules changed. I'm just going to look at the date here, June 18th, 1987. I'll just refer to it as 1987. If the property was acquired prior to 87, then the rules are a little bit more permissive to qualify as farming property. On the date of sale or in any 5 years during the course of ownership, if the property was run as farming activity, then the assets qualify as qualified farming property for the capital gains exemption as well as the transfer to family members. If the acquisition of the property is post 87, then the rules are more stringent, and there is an extra 2-year revenue rule where your revenue from the farming operations has to be larger than from any other source of income. And so depending on how it is you acquired and when you acquired the property, you'll fall under one or the other of these categories. So let's see how this then works, how it applies. We can get some tax efficiency, some tax deferral by being able to roll property from the current owner over to other family members and not have tax apply on those transfers. Between spouses, the general tax rule between spouses is that capital property can transfer from one to the other without triggering the taxes. So the cost base, as I said, with the property, you've got a cost base in your property, you've got a fair market value. You can transfer over to your spouse, and your spouse takes that property at the same cost base and the same fair market value that you had as you own that property. And the benefit you're trying to get from that is to spread things out a little bit to reduce taxes by having income perhaps coming into two people instead of one. And because we've got marginal tax bracket system, instead of having one person who goes up in a higher tax bracket sooner, you've got two of you that that are able to use the lower brackets and less taxes. In concept, that's what you're trying to do, and that you want to try to multiply out the people who are going to be taxed on the capital gain, again, each being subject to their own marginal tax rates, and the availability of the capital gains exemption. The problem that you can run into, though, is if you transfer at cost base over to spouse, then you as the transferor continue to be taxed on the income that is generated off of those assets and on the capital gains on the sale of that property, including that because it's your capital gains attributed back to you, only your capital gains exemption will be available. So if you can set it up instead where the transferee spouse is providing something as consideration in exchange for the transfer, then the transfer can be at fair market value, or some part of it can be at fair market value. So you can have the income generated in the spouse hand as well as the capital gain and the capital gains exemption. So again, conversation with your accountant about how that had been done in the past or how that can be done as you look out further into the future. As well, apart from transferring between spouses, you can transfer to a child and roll to that child at your cost base and your fair market value. So in doing that, what you're doing is you're deferring off the taxation of the capital gains. However, you got your own capital gains exemption. So that's not something that you want to just transfer directly at cost base, because $1 million of capital gains exemption is available to you. You'll want to set that up in a way, with the benefit of tax legal guidance professionals involved, to use your capital gains exemption yourself and spouse, setting this up on both sides, and then facilitate for those children to do the same. So in doing that, you roll to your child, who then gets a bumped up cost base for him or herself based on you having used your capital gains exemption, and then they'll have a lower future capital gain off of that, as well as having the availability of the capital gains exemption. And the transfers can be to the next generation, or it can be down as many as 2 generations. So child, grandchild, great-grandchild, natural or adopted, as the points show here. It can also be to spouses of those children, or, and this would be the case if maybe you and your current spouse don't you aren't an original nuclear family yourselves. Maybe you got together later and your spouse has children separate from you, so the transfers can go to your spouse's children in that way as well. So it's a pretty broad group of people that you can potentially transfer out to. So that's the rollover that can happen of the property. But just coming to the last points I'm going to make here, if you roll everything over to those family members, when we started off this, I was talking about the different kind of planning you have: planning for yourself, planning for the farm, planning for your successors. One of the key points in planning for yourself is what kind of lifestyle you're going to have, and where's your income going to come from for that? Where's that going to be sourced from? If you roll everything down, then you're not harvesting out, sorry to use the word, but you're not harvesting out the cash from the assets that you own in doing that. And you may very well want to do that. So one of the things that you can do is, it doesn't have to be only doing the rollover or only doing a sale to your successor family members. You can do bits of each. When you transfer property to someone and you don't receive all of the price paid to you in a single year, then there's a general rule that allows you to take a capital gains reserve for up to 4 more years. So you spread the tax liability over up to 5 years, so the year of the transaction plus 4 years. Where you have the purchaser being someone within that extended definition of child, then they can buy from you, and it can be extended over as much as 10 years for the capital gains reserve. So that's going to do a few things. It's going to give you flow out of the assets that you own from what you own in the inheritance that you are facilitating for them. So that's going to give you cash. It will relieve them of the need to come up with all that cash at one point in time. And it will also allow for you not to be taxed in a single year on a capital gain, but spreading that out over the course of time so that you have the taxes being taxed to you year to year, each time going up through tax brackets, rather than at one point going up and then you hit the top and you have all this income that happens at top bracket level. And then the other thing that it can do for you is, if structured properly and well advised, it can alleviate some of those concerns that you have about that alternative minimum tax that I was talking about. So once again, conversation with your accountant, your lawyer, to make sure that your affairs, your assets as you own them now, and your expectations about how you're going to do this are set up in a way that you have the least of the negative parts of these tax incursions applying to you when you come around to doing the execution of your succession. So Lindsay, I'm going to bring you back in here and see if we have any questions. That's everything that I have that I'm speaking to on the points here. We do have an article that parallels the content that I've been going through here, that fills in the blanks of anything maybe I jumped over something, because sometimes I just get lost in what I'm talking about. So it's got the text written version of things that will provide you with a little bit of reading material and fill in those blanks. And so Lindsay, I'll bring you back on and you can let me know what questions might have come up.
Thank you so much, Doug. A couple questions here. What is the difference between selling land to your children personally or to a corporation that they may have set up?
So if you sell to them personally, of course, the money comes from them directly, individually, out of their own sources. If they set up a corporation, then the benefits, the features that I was talking about using a corporation will be available to them by acquiring that property inside of the corporation. The corporation transfer to a child's corporation is something which can be or has been a concern based on the tax rules. If they acquire with their corporation instead of personally, that it may end up that they don't get the proper tax treatment on it. They may be taxed as a dividend instead of a capital gain. There was a piece of legislation, it's called Bill C-208, which was passed into law last year, and it was a private member's bill. The governing party that's back in again, the Liberals, they were bound to have it passed. It's been given royal assent. We haven't seen the details of it yet. So any of you who may have come across this, that it's a concern about transferring to the child's corporation rather than personally, check with your lawyer or accountant about the progress in that new law, and whether it is now available to you to give you more flexibility on transferring to your children.
Thanks. Here's another question. I have a corporation which my land was transferred into years ago, and we are now renting out the land. Because I am not actively farming and I'm just renting it out, will I lose my qualified farming exemption if I decide to sell? Can I sell it to my successor, and is there a time frame I need to know about?
Yeah, and that's the time frame, or that's that point in time in 1987 on the acquisition, that depending on when you acquired that property, if it was acquired prior to 87, even though subsequent to that time you have you've rented that property out, it may nonetheless still qualify as farming property. It's less likely if you acquired after 87, and it does depend on the facts. So have your professional advisors take a look at that and can advise you whether you're going to have the benefit of that or not.
Great. And another one here. I would like to gift some farming land to my successor. The land is held in my personal name. What are the tax implications of doing this for me and my successor? We want to pay as little amount of tax as possible.
Okay, so it does depend on how much is involved, and whether you want to have some of it go by way of the rollover or by way of the purchase from the child. There's no black and white answer to say do it this way or do it that way. It's a matter of looking at the facts and then coming up with a way of doing it so that overall you reduce the total taxes involved, because you could set it up so that you reduce your personal taxes right away. And the easiest way to be doing it is if it's a child under that extended definition, you just roll that child, no taxes whatsoever. But on doing that, there are later taxes perhaps that will be visited upon that child on the later sale of that property, and it may be that doing some as rollover and some as an acquisition may be a better way to reduce down the total taxes for you, for him or her, now and out into the future. So some analysis is necessary in that case.
I do have another question, which might be a good follow-up. Is there a difference in the ACB on the sale of the corporation depending on if the purchaser is at arm's length or not?
That can be a concern, similar to that the mention I made of Bill C-208. There can be some concerns about the cost base of how the cost base is affected on the transfer of the property, but that's it sounds like a very specific situation that might be behind the question. So I would say pose that to your accountant to see. Generally, accountants are going to deal with the numbers associated with things and are going to be the planners of how this is done. And then where something has to take legal effect to make sure that it actually you cross the T's, dotted the I's, that's where the lawyers move in. Although both do provide planning services, does tend to be led by the accountants.
And I guess we've got time for one more here. So final question is, why wouldn't I choose to spread the capital gain on the farm over 10 years?
It may be just the amount is just not necessary to do so, but yeah, transferring it over the course of that 10 years is usually going to end up with reducing down your tax bill on the capital gain. Where it may be a concern, again, depends on your circumstances. This is where, again, this is actually extended out beyond lawyer and accountant to your financial advisor. Projecting out the income sources that you have. Let's say that that you have a substantial capital gain, and by spreading it out over the course of a long period of time, it might push you over the level where you have the old age security clawback. So you may lose the old age security for 10 years if you spread that capital gain. Whereas if you had it just in 1 year, as painful as that might be, it would preserve the other 9 years of, you would lose it 1 year because of the large capital gain, but maybe you get the other 9 years of old age security. And that's just an example of another consideration that might go into it. But usually it makes sense to spread that capital gain over the long period of time so that you get more access to the lower tax brackets for a longer period of time.
Thank you for the presentation. Lots of great questions. We're at our 10 o'clock here, so I will leave any final comments before we wrap up, Doug?
No, I do. Again, I said off the top, my background is estate planning and tax planning, and specifically here we're talking about the succession. When you are getting the advice that you're receiving, just make sure that you do consult with the whole range of professionals, because their particular perspective will work for their particular view, the legal side, the tax side, the investment side of the excess money, and coordinate those and make use of all of the professionals you have available to you. Don't assume that one professional can do everything. Maybe in a really simple activity, simple operation, that would be sufficient, but usually the involvement of all your professionals is going to get you the best benefit of using all the expertise.
That's a really great point. Team approach. Thanks so much, Doug. Okay, bye-bye.
Okay, thanks.